The Cabinet Committee on Economic Affairs has given its in-principle approval for strategic divestment of IDBI Bank, along with the transfer of management control. LIC's board has also passed a resolution to the same effect. The government and LIC hold 94.7% stake in the bank as of March end, and they plan to sell all or part of their stake in the lender. At the current market cap of IDBI, Government of India can raise around 18,000 crores by fully exiting its 45.48% stake in the bank. While the government may be in a rush to exit, LIC has been granted a 12-year period by the RBI to bring down the stake in the bank to 15% from the current 49.2%. LIC, however, may want to unlock value of its holding in the bank before its planned IPO in FY22. Coming out of the PCA framework in March has paved the way for IDBI's proposed sale. While the ground looks all set for divestment, the consideration desired may be at least 40% higher than the current value ascribed by the street. That is because LIC has invested 26,367 crores in the bank since FY19 at an average price of 54 rupees a piece, whereas the current market price of the IDBI bank share is 39 rupees. LIC may be unwilling to offer the stake below 61 rupees since the majority of investment has happened at this price. Exiting a big investment of more than 25,000 crores at a loss is highly unlikely for LIC, especially given its upcoming IPO that would attract higher scrutiny of its investment style. So the question is, can IDBI Bank command more than the current market cap? At the current market price, the bank is trading at 1.2 times book value estimated for FY23, which is at a premium compared to its peers. Even SBI is trading below FY23 estimated core book value. IDBI Bank was placed under a prompt corrective action regime in May 2017 by the RBI in view of its high NPAs, poor capital position and negative return on assets. Certain sanctions were imposed on the bank which were aimed at restoring the bank's financial health. With the help of several capital infusions, the bank took steps to reorient itself back onto a path of profitability. After posting net loss for 5 consecutive years, from FY16 to FY20, IDBI Bank reported net profit of 1,359 crores in FY21. The bank has seen significant improvement on several parameters. Net NPA ratio declined from 16.69% in FY18 to 1.97% in FY21. Provision coverage ratio rose from 63% in FY18 to 97% in FY21. Retail advances increased from 44.56% of total advances in FY18 to 62% in FY21. Risk-weighted assets fell from 2.2 lakh crore in FY18 to 1.5 lakh crore in FY21. Share of CASA deposits surged from 37.15% of total deposits in FY18 to 50.45% in FY21. Proportion of bulk institutional deposits is down from 37.5% of total deposits in FY18 to 11.62% in FY21. Operating metrics have improved on the back of a favorable shift in the asset mix towards non-corporate segments, an improvement in the deposit profile and lower deposit costs, high recoveries and fall in credit costs. Credit cost and slippages ratio is likely to remain below 1.5% and 2% respectively in FY22 as the overall riskiness of portfolio has reduced and the bank has substantially ramped up on its provision coverage ratio. Setting up of National Asset Reconstruction Company would boost the divestment process. Since IDBI Bank is already well provided for legacy assets, it can transfer some of the bad assets to NARCL, making the bank more attractive to a potential buyer. Exit from PCA in March has given the bank some flexibility in lending and expansion of its network and will support bank's profitability going ahead. While the current valuation is pricing in the improvements in operating metrics and profitability, there can be further upside driven by potential sale of bank. Undoubtedly, privatization would unlock value of IDBI's deposit franchise. With the bank's market cap to deposits ratio just at 18% compared to more than 30% for small to mid-sized private lenders, there's possibility of further upside in valuation. Moreover, since LIC is willing to cede management control, the sale could also entail control premium over and above the fair value of the bank. For a bank that has been nursed back to health, divestment can fetch more than current market cap, driving the stock upside.